This is an American Chemical Corporation case prepared for Dr. Shiroki by Carrie Barclay. The overall assessment of American Chemical Corporation is very good. The range of years from 1974 to 1978 proved to be a successful period of American Chemical. The Standard & Poor's have given them a rating of BBB to A for that time period. Also, the company's stock price has seen a steady increase from $19 in 1974 to $44 in 1978. Therefore, their dividends per year have also increased throughout that period. When looking at American Chemical Corporation's sales and net income, there was a steady growth until 1975, where there was a 3% drop in sales and a 61% drop in net income. Besides that year, the company saw growth and even continued to show growth after that drop in sales and net income. There is a tough competitive environment for American Chemical Corporation and the Collinsville plant. The sodium chlorate and chloride are key components used to make paper. There was a demand for the sodium chloride, which was expected to grow from 8% to 10% a year. Two firms, Union Chemicals Corporation and Louisiana Paper Company, both announced to construct new plants in 1980. This would increase competition for both American Chemical and Collinsville. Also, this would increase the industry capacity, and that would lower American Chemical and Collinsville's margins. To calculate the unlevered beta for Collinsville, I first had to calculate the unlevered betas of pure-play sodium chlorate companies Southern and Brunswick. I then took the average of the two unlevered betas to calculate Collinsville's unlevered beta of 1.046. Then, to calculate the levered beta, the debt-equity ratio used was 0.35 over 0.65, which calculated the levered beta to be 1.609. Collinsville plant's cost of equity was calculated using CAPM. The risk-free rate was 2% and the market risk premium was 7.5%. Taking the market premium of 9.5% and subtracting the market risk premium of 7.5% computed the risk-free rate. The equation shown shows how it's calculated, which gives us a cost of equity of 14.07%. The cost of debt for Collinsville is 11.25%. The after-tax cost of debt is calculated by taking that percent and multiplying it by 1 minus the tax rate of 48%, which gives us 5.85%. To calculate the WACC, the appropriate weights of 0.35 for debt and 0.65 for equity, along with the tax rate of 48% were given. The WACC was then calculated to be 11.19%. Now that we have already calculated the WACC, we now need to calculate the free cash flows. They are calculated using the capital expenditures, depreciation, changes in net working capital, operating profits, and depreciation. The table shown shows the calculations which lead to the present value of the free cash flows. Once the cash flows have been calculated, the NPV can then be computed with selling assets at book value at the end of year 5 and year 10. With the factors taken into consideration, the NPV for 5 years was calculated to be negative $407.49. With the inclusion of the laminate technology, the NPV is drastically different. This could be due to the cost of savings associated with the $2,250 investment in the laminate technology. The table shows the computations for NPV after 10 years. The NPV is now positive and equals 1515.22 if the plant is sold at book value at the end of 10 years. Including the investment and cost of savings, the payback period was calculated to be 2.11 years. Also, when using the laminate technology as a basis for IRR, the IRR is calculated to be 41%. Using the WACC that was calculated to be 11.19% as a reference, there is an indication that the project should be undertaken. The IRR is greater than the WACC, which shows that the project could be profitable for the company. The NPV changes dramatically with the inclusion of the laminate technology. The NPV is calculated to be 7,187.39. This is the highest NPV out of all the options presented and calculated. The table shown shows these calculations. This proves to be the best decision since the calculation represents the highest NPV out of all other options. The Collinsville plant increases their market shares and their profits if the proper investment in laminate technologies is made. So, strategically speaking, the Collinsville plant is attractive. As an independent consultant, I would recommend that Dixon Corporation acquire the Collinsville plant. That is the option that is going to lead them to the most profitable, since that option As an independent consultant, I would recommend that Dixon Corporation acquire the Collinsville plant. That is the option that is going to lead them to be most profitable since the option returns the highest NPV of $7,187.39. When looking at financing for an acquisition, the most important key factor is the company paying back the debt they consume. It is important to notice that the $12 million used to finance the Collinsville plant is all debt capital. If the company invested in the laminate technology, they would have a greater chance of paying back their financial obligations since the IRR is greater than the WACC and the NPV is at its highest.